there was supposed to be 3, then there was 2, and who's left but the big guy? Greg Weldon, thank you, my friend, for being the one guy that kept the appointment and is here to talk.
Anytime. I was here watching basketball anyway, so what better time than to do a little halftime interview with the great Peter Grandich.
Well, listen, Andy Scheckman and Ben, we're going to get to them in a later date, but glad to start with you because I'm gonna get right to it, right to the core. I'm watching the Fed yesterday. I hear the numbers they put out. I watch his press conference, and I say, wait a minute. Inflation went up. GDP was taken down.
Uh-huh.
Isn't that what Greg Weldon was talking about, something called stagflation? First of all, remember, Greg, you and I go about the same time. 45% of the kids being financial advisors right now weren't even born when you and I started. So they would know stagflation if it hit them in the face.
Yes.
But that's what it sounds like, Greg.
You're starting to see even some of the financial media, the prime media start to use that word. It's the ugly S word. And I've been talking about this really since last September, with a real kind of vigor that, we're seeing this. And when you dig into the data, we've seen this for months. And now the visibility of that data has kind of risen to the top where the Fed is acknowledging it. And you want to talk about, one of the things around stagflation. I mean, like you just said, they cut their forecast not only for nominal GDP, but for real GDP, because also raising the inflation forecast. So not only was it nominal GDP lower, but then real GDP was cut again because of higher inflation. So this is a double whammy in terms of growth. And if you look at the range of Fed estimates for growth next year, the bottom end estimate of real GDP growth went from 1.4 to 0.6. That's the bottom line as to some members of the Fed see that GDP growth could be as low as less than 1% on a real basis next year, and inflation could be above 3, meaning you have nominal growth, but it's obliterated by inflation. But we've seen this already in retail sales, in some of the employment numbers. I mean, you've seen this in the ISM. You've seen these things where inflation has hit spending, has hit consumer final demand already. And the talk still, it's just amazing to me that we got the retail sales number. I think it was actually this week or late last week. It's like one long day for me anymore, a week. So I'm up all night doing this stuff. But when you got the retail sales number, it was kind of interesting because people looking at eating and drinking establishment sales are now falling for 2 months in a row. And that's a real rarity. And people all of a sudden are realizing, guess what? You have some disinflation that could become deflation in retail sales. Well, guess what? Retail sales doesn't account for the increase in prices of the stuff you're buying. On an inflation-adjusted basis, retail sales have been deflating for almost 18 months, And when you look at retail sales, what's interesting about this number is that, it was an unimpressive number of 0.2 for the month. Well, let me tell you something. If not for some shenanigans in the background around the seasonal adjustments, this would have been a deeply negative number. Here's the numbers. I'm going to give you the exact numbers because it's important that we have these numbers exactly. When you're talking about the retail sales numbers, all right, the last year, non-adjusted was up 6.8 billion from January to February. And understand, when you go to December to January, you have a big decline in actual sales. They have seasonal adjustments. The seasonal adjustment is pretty much the same every year. It doesn't change a lot until now because you had the Jan-Feb last year was 6.8. The seasonal adjustment was 680 billion. You had an actual number of up 7.5 on an adjusted basis. So the increase was barely more than $500 million, all right, 682 million actually. This year, the unadjusted number was down 26.5 billion in sales, all right? The adjusted number was up 1.4, which meant the seasonal adjustment was 27.9 billion. Almost 28 billion in seasonal adjustment this year, which is more than 10 times, it's like 20 times the seasonal adjustment you had last year. So without that, you have a real problem. Not only that, but you're talking about the retail sales, eating and drinking establishments. The year-over-year change in dollar terms was 1.4 billion. That's a very small number. In fact, it's the smallest non-pandemic number since 2014. Then when you take the real retail sales year-over-year at 1.5, compared to inflation, it's down almost 2%. All right, so this is a consumer recession. When you're talking about credit card debt is higher than savings. When you're talking about personal spending, it's higher than disposable income. You're talking about the consumer, like public debt over GDP, has crossed into this debt black hole. And we see delinquencies are through the roof on automobiles and credit cards, levels we haven't seen since 2008. We also see consumer sentiment is souring at such a fast pace, it's not even funny. Just look at some of these numbers. We're talking about sentiment from the University of Michigan survey, from consumers, from households earning above $100,000 a year, is the lowest it's ever been. We're talking lower than 2008 and 9, lower than 2000 tech bubble crash, lower than a recession in 1990, which you and I both remember was vicious, all right? The number expecting business conditions to worsen is 58%, the highest on record. I mean, the consumer is screaming at us that we're in a cocoon, we're getting crushed. It's like you ever go and you see the cars get smashed in the junkyard, man. That's like the consumer. I mean, he's getting crushed from both ends. So to me, this dynamic around this narrative that's been put out there by Wall Street that the consumer is healthy, and after retail sales, there were two prominent bank, brokerage house, talking heads that came out and said the consumer is quote unquote healthy. It's just like these people keep talking their book on TV because everyone's so desperate to have the stock market go up perpetually. The stock market, I told you a couple of months ago, headed for an economic reality check, and that's exactly where we are now. I could throw labor market numbers at you. You're talking about the labor market last month where the number of employed fell 588,000, where the number not in the labor force rose by over 600,000. People dropped out like crazy. It's the only reason it doesn't show up in the headline numbers. The number of people working part-time for economic reasons was up over 500,000. I mean, these are real serious signs of stress in the consumer. So I think you have a Fed that is starting to understand that they're going to probably have to move more than they want to protect growth. And while they have this period of uncertainty, they can kind of say, well, we're going to hold off a little bit and whatnot. But we know that the stage is set for them to do exactly what we said they would do: acquiesce to higher rates of inflation to protect growth. They were all over this. They cut their forecast for GDP. They raised their forecast for inflation, but they still expect to cut rates 2 times this year, if not 3 or 4 times by the end of next year. I mean, that's acquiescing to higher inflation in my book. So that's one of the base cases here for gold. And it's a base case to see the dollar decline, but that's a whole nother story and maybe a step away still.
Okay, so first of all, for you and I that once used to appear regularly on CNBC, or what I like to call in the last 20 years, tout TV,
yeah,
they have a new requirement. I don't know if you knew it because you haven't been there in a while. When you get in the green room, you have to take these pom-poms and for 5 minutes, rah, 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 before they let you on. Anyway,
yeah.
Bottom line, so weaker times ahead, a Fed that's going to have to adjust it. Now there's a little hiccup. Curious, and I want to talk to you about the dollar and gold, and then I know you're busy. I'll let you go. But Peter Schiff put it out that of the 36 trillion outstanding debt, 28 trillion matures in the next 4 years.
Yeah. And
we're not seeing any real movement on cutting the deficits. How, in God's name, does somebody expect on it's still 2%, which they pushed out to 2027 now. It's quietly done in that, even though core is still at 3%.
Yeah. We're
going to have a tough time financing this debt, especially if the economy slows down.
Yeah, unless, what do you think? QE. I mean, come on. This is the thing. This is where my whole theme of the debt black hole. All right, the simple fact, and we can make it a lot more complicated, but we can make it very simple too, which is that when you take household debt and you take public debt, which is basically household debt, under a different name, you're talking about $54.9 trillion. All right, and when you compare all of this relative to where GDP is, you're looking at about 186% of GDP. And what does that mean? It means you have to create $1.86 of new debt to create $1 of growth. You're into the debt black hole. You cannot get out. You will try and burn as much fuel, as much propulsion. There's no propulsion methodology using enough fuel that's going to get you out of the gravitational pull of a debt black hole, by scientific terms. In that sense, we will burn money. I mean, that's going to be our propulsion. That's going to be our jet fuel. And it's one of those things, too, if you look at the XRT retail ETF in the stock market, a very good measure as opposed to the XLY, consumer discretionary, which includes Tesla and Amazon and some other things. But when you look at the XRT, which is the retail ETF, relative to the S&P 500, it's at a level it's only been at twice before. in the pandemic and in 2008. And to get this thing back up relative to stocks, and we know consumers are still the economy, all right? So you need the consumer to drive the stock market if you want a kind of organic growth after you have a big correction, I think. But the dynamic there even is that every time we've been at this level, it's been a spark for QE. And you talk about the debt relative to GDP. I mean, it's going to be QE. It's the only way out. We chose this way all the way back in 1990. To me, was the last time we could have really paid down debt. You had the budget surpluses under Clinton. You had a chance, but we blew it after the tech bubble crash. And ever since then, it's been printing money, monetizing government debt, and this leads to a lower dollar and higher inflation. And the biggest thing it leads to is a lower standard of living and a decline in the purchasing power of the paper currency. And this is where we're in this cycle now. And it's one of these things that's like the next step is to get the dollar down. Well, what does that do? It stokes inflation, right? So this is the cycle we're in. We're in the kind of that loop now where it's really dangerous. And, being passively invested in stocks in the next big low, which I think is out there, but, you're going to have to get there first because you're not even close. To think that this market is corrected this much and that's enough is very short-sighted, in my opinion. Not only technically, but fundamentally too. You need to get the dollar down. It's the most positive, inverse correlation of any two markets is dollar down, stocks up, dollar up, stocks down. And you've seen the stock market go up despite the fact the dollar's been strong. You've seen gold go up despite the fact that the dollar's been strong. Well, the one that's going to keep going when the dollar reverses, of course, is gold, but then stocks will come too. But to be passively invested in stocks and to think you're going to, outpace the devaluation of the purchasing power of paper money is also short-sighted. So it's going to take a lot more work and a lot more outside the box thinking to keep pace in the next round when the Fed moves again, and they will be forced to move because you need the growth or you can't service the debt. And a debt deflation is way worse. I said in a book I wrote in 2006, when staring into the debt abyss, central banks will choose to reflate no matter what the cost, at every cost. And that's where we're headed right now, even though it seems kind of far-fetched to think that way right now. That's the way I'm thinking.
So let me ask you one question and then gold, and then I'll let you go. Does the political / tariff situation accelerate where you see we're heading, slow it down, or really have no effect?
This is a call out to all Warren Buffett fans out there. Pay a visit to Intelligent Investment Today, a weekly shortcast dedicated to the teachings of Buffett's tutor and mentor, Benjamin Graham. We explore ideas including the parable of Mr. Market and the margin of safety principle, which have proven vital in Buffett's rise to investment superstardom. So don't delay, check out Intelligent Investment Today.
Well, I mean, I guess the first question is, how real and how sustained is this going to be? Because this is, political bargaining. It's more than it is a policy that we're going to carry out for the next several years. So that's number one. And when Fed Chairman used the word transitory, I hate that word because it's been misused.
I never thought they would use it again. Greg, when I heard you say it, I joked. I'd written that you would never hear the word transitory by a Fed official again. That's why I was shocked that he used it.
We were trashing that word so much, back several years ago that it wasn't even funny because it was so obvious. But in this case, it might be more applicable, unfortunately. But the fact is that, bottom line, this again kind of puts the dollar in play. And whatever does come of this, I've actually taken the things that we import that we're going to put tariffs on. I've done the math. And I mean, you're talking about adding 0.6 or 0.7 to the headline CPI inflation number on a year-over-year basis, puts us near 4%. So I think that is a problem for the Fed. And the Fed can say it's transitory all you want, but you also have to remember another thing that we're seeing that I don't hear much talk about too, and it has to do with tariffs, but it's not all tariff related, is supply chains. And we're starting to see like logistics managers survey, one that I watch very closely. You're seeing there was a big move to increase inventories before this tariff because you thought you might be able to import goods. You increased inventory so you'd have stuff on hand and everything. But that drove up warehousing costs, transportation costs, inventory costs even. All of these things are back in some cases at levels above the pandemic highs. So you have this whole thing where you have the inflation within the system too that is also working through, let alone that inflation in services it's great. I heard somebody say the other day, and this really is one of my pet peeves, when somebody said, prices are coming down. It was a politician. And he said, prices are coming down. Nothing is further from the truth. Prices, price of eggs have come down, and some things have come down. But in terms of the year-over-year rate of change, that has slowed. It hasn't gone negative, not at all on a headline basis. When you look at the service sector, over 60% of service energy items, and there's 74 sub-indexes in that category, all right? And let me get the exact number. 49 of them, or over 66%, are still above 3%. 43% are still above 4%, and 22% are still above 5%. That's more above 5% than are below the Fed's target of 2% in services. This is the kind of inflation that is stickier. It's harder to wrangle out. Monetary policy is not as good at doing that. So I think that you still have this inflation problem, where another thing I said on your program here was you would see inflation come down in disinflation terms, okay, into, we said October, November, all right, we're pretty close on the timeline, and then you would start a new uptrend. We're in that new uptrend. And, when the Fed, again, when they tell us they expect inflation to be higher, they don't see a case where inflation comes back down to target within the next 2 years, maybe even the next 3 years, and they're still going to be cutting rates. That tells you a lot. That's not to say you couldn't have a Fed funds rate of 3.25, right? If inflation is 3 and you want to have a neutral policy, but they're saying they don't want neutral. They want to remain restrictive. So it's interesting to see the back and forth, but I think ultimately the Fed will be pushed. Let's not forget, when the AVB Bank, or this whole thing that happened in Silicon Valley, I guess it was SVB Bank, Silicon Valley Bank, went bankrupt. You know how quickly they turned around to print money in huge volumes? It was so fast to make your head spin. That's the kind of thing they're capable of doing. And not much talk about the fact that they downsized QT in this meeting too, which I think was a big deal, from 25 down to 5 billion in treasuries. And that's an 80% reduction in QT. That was no small chump change either. But nonetheless, the fact that they've kind of pushed off rate cuts has actually lifted the dollar, which is kind of a risk to all these asset prices, including gold. Gold's acting a little herky-jerky here because the dollar made a nice comeback today, but I don't think that's going to last.
All right, before I ask you the last question about gold, I want to just say something serious to whoever's watching, whether they're followers of mine or whatever. Greg eats and sleeps this. And sleep is a limited word, because I know the times I've had communications at 3 o'clock in the morning because you're doing all this economic studies and all this kind of stuff. People aren't working like you work now. They really aren't. Seriously.
They don't dig into the data.
I'm not stroking you. I'm not saying that to stroke you.
Appreciate that.
But I know the work that you do. I think that's the problem for the investment community, because financial advisors are not putting in the required time.
And I love it because it gives me a business. So that's great, but what it is, I'm not the smartest guy out there, but I'll outwork everybody. That's always been my way, grindstone. I love to grind it out, and I love what I do, and I'm a mathematician, and I love putting the pieces of this 3D puzzle together. Remember the great Bruce Kovner, who worked at Commodity Corp when I was at Commodity Corp? It's a 3D puzzle. It's a 3D chess game. And that's a great analogy, because you got to look at so many different angles, so many different perspectives. So I love to I need to know what's going on in every country, because even what's going on in Angola or Nigeria or Pakistan means something to me in the bigger picture. It refutes or supports the bigger picture themes that we have. What I think people don't do is dig as deep into the data. I mean, it's simple. You look at Twitter. It's like people go on Twitter, they read a bunch of headlines. They think they know the whole story behind the data release, and they don't. And it's funny, because I was actually blasted a few people on Twitter the other day, people that post this, retail sales were up 0.2, not great, but it's consumer remains healthy. And it's like, did you even look at the numbers? I mean, come on, man. So it's great. I feel fortunate because it gives me a business and it gives me a job. But I'm also a CTA. I mean, so we manage money doing this. And that's what, makes sure that I'm, locked and loaded in my cave here. Luckily, I have a beautiful view of the lake out here. It's important to me, to be in a place where I have light, where I have, nature, where I can run to the gym for an hour. I can even run out at 5 o'clock and hit some golf balls, because to me, it's as much as I work, which can be anywhere from 12 to 16 hours a day. I feel like I'm on a part-time working vacation all the time, because I just love what I do. And I appreciate your comments, because, I'm at my desk 2, 3 o'clock most mornings.
And Actually, I have to one little quick question at the end, but let's first cover gold. What's your latest thought on gold?
Well, we had 2650 was last year's target at the beginning of last year, beginning of 2024. And then we upgraded to 3000 here on your program and said, it seems even crazy to have said 2650. Then we're saying 3000. If you remember, I gave you my 3 to 5 year forecast at that point ahead, and it was in the 49.65 range. So it's kind of interesting, 49.45, I think it was. When you look at take a place, for example, like India. All right, India just cut rates. They're going to cut again. Their inflation's come way down and everything. But if you look at the price of the Indian rupee in gold, it's quadrupled since 2016. Think about the debasement of the purchasing power of the Indian currency for 1.46 billion people, now the most populous country in the world, right? That just went through this massive depreciation in their currency. I mean, so to me, the thing to kind of keep in mind is this is global, and that you haven't, until just now, just this last run, something we've talked about, you haven't had the Wall Street crowd start to rotate money in. You haven't had the ETF players come back because they all sold out. You haven't had a big rise in open interest, not a speculative froth here. It's gotten a little bit more attention, but it's still not even there yet. You haven't seen that big rotation yet. So I think that the upside is, it's one of the things I always worry when I get too one-sided, and I always want to check myself, and I always want to find things that refute my opinion. And the only thing that I really see kind of standing in the way here is either a Fed policy error that creates an entire asset price collapse that takes gold with it. That's not a zero probability, but it's not a high probability either. And I just don't see what's really going to derail this move at this point in time. So it's one of those things that you look at the mining shares, they're just now breaking out. And not only are they breaking out, here's the great thing. The junior gold miners breaking out against the NASDAQ, all right? The GDX breaking out against the Infotech, the S&P XLK. So you have, and big double-digit outperformance relative to the S&P. You've got reasons now to see that kind of rotation. So the mining shares, we did the special, just this past week, and I think you posted that on X. But to me, these kind of moves are still very much early stage.
Okay, so the last question I have to ask you, I have to preempt it because if I ever run into you again, you can kill me with one swoon. So I say this out of love, and it's going to be the hardest question I could ask you to answer, and it'll be the only one. It's going to be the one where you might not be 100% objective.
Right. Okay.
Are the Rangers making the playoffs?
Oh, I don't think so, Peter. I think they're too far behind. They've played more games. They don't have as many opportunities here to get points. The last two games have been very disappointing. The game at home that they lost to Columbus was a nightmare. I do think one of the things I said in the middle of the year, the last two seasons have been brutal. When we were up 3-0 against the Devils and they came back and won 4 straight games, it was devastating. Last year, we ran into a buzzsaw in Florida. They were just a better team, more physical, and they manhandled us. But we were the best team in the league last year, record-wise. Right. So this has been really hard to take. And all of a sudden, the team stinks. It's all the same guys, but they stink. And then Lavalette and Drury start moving people. And you kind of wonder, okay, well, I will say this. Lavalette's a winner. He's gone everywhere he's gone. I feel like we have to give him time to do their thing and to get the team that they feel will play their game best. Some coaches are good at using the talent they have. Other coaches need the talent to play their style, all right? It's two different things with coaching. I've seen them both in my basketball career and my limited hockey career. So I think that in this case, the Rangers' setup now is we need the players that will play the system that Lavalette has used in the past to win. So I'm willing to give them a chance to kind of rebuild this team in the way they want to see it. But it's a rough road. It's been a tough season. And yeah, I don't think they're going to make the playoffs. And frankly, I was talking to somebody about this yesterday, and I said, why do we want to make the playoffs? We're going to go into Washington, get our asses kicked, and I just as soon watch baseball. So I'm getting primed for Yankee season.
One, just as you said it, that you had that brief career in hockey. How tall were you when you put skates on?
I was easily over 7 feet on skates. And what's funny, Peter, is I played hockey before I played basketball. And of course, back when I was a kid, we played all sports. So, weren't pigeonholed into one sport like parents do with kids these days. So, I played golf. I was on the golf team. Went to football camp. I went to Joe Namath football camp 2 years in a row, but I was hockey and basketball were my two primary sports. And as a freshman, all right, I came in and I hadn't played in 7th and 8th grade. I was a hockey fanatic, so I was playing hockey the whole time. I get to high school, as a freshman, I grew to be 6'5", and they're like, you need to come on and play on the basketball team. So I did. I went out, and it's funny because I've had this story from my freshman high school basketball coach who told me this just recently. Only recently did I hear this story, that they weren't sure whether I was really into basketball or not, right? And it was kind of like literally the last man taken, believe it or not. And the head coach told the freshman coach that kid Weldon would rather read a book than play basketball. And I always thought that was a really funny and probably true comment. But yeah, no, I played basketball my freshman year and hockey the same season. And the only way I was able to do that is because freshman hockey got the worst ice time, of course, which was a very valuable thing in North Jersey. They didn't have a lot of, ice rinks and, with the demand for hockey. So, my dad would take me to hockey practice at 4:00 in the morning, and I'd run to basketball practice at 8:00, and do freshman basketball practice and around and play street hockey for the rest of the day. Ultimately, I had to give up hockey and went out to play, of course, basketball at Colgate, and I had my tryout in the NBA, but didn't make it. So it took me a lot further than hockey would have ever taken me, that's for sure.
Well, I just want you to know how much I love you, that I think I can get it. It must be XXX large, but I can send you down a Devils shirt if you need it.
No bother. I'll just have to have a campfire if you send me that shirt. I'll make sure to videotape it for you.
Tell everybody quickly about your services, because every client and friend listening to this, you better start reading Greg's work if you want to really have a real chance of stuff. He just does phenomenal work. But quickly tell us what your work is.
Sure. It's called the Global Macro Strategy Report. It's just one product now. We've done away with the Gold Guru and the ETF stuff, and it's all been condensed into the one product. It's a daily product. We give specific recommendations in foreign exchange, fixed income, global stock indexes, precious industrial metals, the energies, and the agricultural commodities, which I think have been huge and are going to continue to be huge. So you can get a free trial to my service by emailing me at Greg, G-R-E-G, Weldon, W-E-L-D-O-N, at Weldon Online, one word, weldononline.com. Now, we're also, I'm also a CTA Series 3 registered, and we are accepting new money right now, which is not always the case. Accredited investors only. There's a lot of give and take here, and we need to make sure you're good for us and we're a good match for you. It's $1 million minimum, which is a high minimum. Why is it so high? Not because we want to charge big fees. We don't. All right. But because the markets are these prices on some of these futures are so high. It's a futures program. The money is held in your name. There's no commingled funds. I get a limited power of attorney to trade. It's an account in your name. You see it every day. We provide full transparency. The only way I can be credible is to be 100% above reproach in terms of our disclosures, and to be fully transparent. So our clients see their money, the positions, the wins, the losses, everything, every single morning if they choose to. Some people don't, a lot do. In that context, we have had a string here since we put this particular program together, which is designed specifically to help investors keep pace with the next stage of what's coming in the devaluation, the purchasing power of paper currencies everywhere, and especially here in the U.S. So to that extent, we've done a real job. I don't get into particular numbers in a public forum like this, but we have outperformed, we have kicked butt, and our customers are very happy. And for a limited time here, we are accepting new customers on the CTA front. Also, email me just straight up, Greg Weldon at Weldon Online, and we send you all the information on that.
Well, that's great. I hope everybody takes you up.
And I would add, because if I don't, my producer will smack me around, the podcast, Money Markets and New Age Investing. You can find that on Twitter at money_podcast. And of course, I'm on Twitter at Weldon Live, L-I-V-E.
Well, let me just tell you about, and then I'll close, that you said about not looking at your statements in the morning. If you're a junior resource stockholder like I am, you learn not to look at your portfolio.
Yeah, no comment.
All right, Greg, my friend. Thank you, buddy.
My pleasure. Anytime, Peter.
God bless you.